Let's dive right into this explainer. Today, we're unpacking a hidden gem in the tax code, the Section 530 Tax Lifeline. If you're running a business or handling payroll, you absolutely need to have this on your radar.
Picture this total nightmare scenario for a second. You get audited over worker classification. The IRS is suddenly breathing down your neck, claiming that those independent contractors you've been using for years, yeah, they're actually employees. Suddenly, you're staring down massive retroactive payroll taxes, steep penalties, the whole shebang. It's the kind of thing that can completely sink a company. But hold on, before the panic sets in, there's a vital provision you really need to know about.
It's a powerful escape hatch, known as Section 530 relief. Coming from the Revenue Act of 1978, this provision literally terminates a taxpayer's employment tax liability for individuals not treated as employees. It is the ultimate tax lifeline. If you play by the rules, it provides a permanent cure for your organization's employment tax liabilities for a specific group of workers.
And honestly, what's most fascinating here is the mandate placed on the IRS itself. IRS examiners are legally required to explore Section 530 first. You don't even have to bring it up. On all worker reclassification audits, they have to consider this relief right out of the gate and even hand you a publication about it when the audit starts. Crazy, right? Okay, so to actually grab this lifeline, you've got to clear 3 strict statutory requirements. We're talking reporting consistency, substantive consistency, and a reasonable basis. Miss even one of these and the relief vanishes entirely. Let's quickly break them down.
Hurdle number 1. Reporting consistency. This is the absolute bare minimum, folks. Forms 1099 must be filed. You have to have timely filed all your information returns consistent with treating that worker as a non-employee. If you're claiming someone is an independent contractor but you just never bothered to file their 1099s for the years under audit, no way, you're out.
Next up, substantive consistency. Basically, this means you or a predecessor cannot have treated any worker in a substantially similar day-to-day position as an employee at any time after December 31st, 1977. And the IRS isn't just looking at job titles here, they're digging into the actual daily services and comparing job functions.
Finally, the third hurdle, reasonable basis safe harbors. You must have had a legit good reason for treating these workers as non-employees when you made the call. The IRS gives you 3 safe harbors here. You can point to a prior IRS audit that didn't challenge your setup, a federal judicial precedent or administrative ruling, or a long-standing recognized practice within a significant chunk of your industry.
But hey, what if you don't fit perfectly into one of those 3 neat little boxes? Well, there's a fail-safe. You can rely on an other reasonable basis. And the really good news? The IRS is explicitly instructed to liberally construe this in your favor. This could mean you relied on the advice of a CPA or attorney, a state law determination, or even just demonstrating genuine good faith.
This leads to a massive structural advantage for your business. The guidance says it plain as day. If the taxpayer has cooperated fully, the burden of proof shifts to the service. Think about how huge that is. If you establish a basic case and just cooperate with their reasonable requests, the IRS actually has to prove you don't qualify. You don't have to prove you do.
To truly master this, though, we need to look at the whole picture. Let's compare the effect on the employer versus the effect on the worker. Because Section 530, it creates this wild split reality between the two.
For you, the employer, the benefits are fantastic. You get permanent tax relief for that class of workers, and the examination is just discontinued. Done. But here's the catch. You must continue filing those Forms 1099. If you get spooked post-audit and suddenly start putting those workers on W-2s, you lose that Section 530 relief for all future years. On the flip side, the worker's impact is entirely different. See, Section 530 is strictly for the employer. It doesn't magically turn the worker into an independent contractor. If the IRS determines through other channels that the worker is actually an employee, their status is unchanged. They're still liable for their employee share of FICA taxes, and they've got to file Form 88919 to pay it. So this all brings us to one incredibly critical question for you to chew on. Would your worker classification survive an audit today? Section 530 is a phenomenal lifeline, but it demands absolute strict compliance with consistency rules and a rock-solid reasonable basis. Don't wait for the IRS to come knocking to figure this out. Take what we just unpacked in this explainer and proactively evaluate your own practices right now. Catch you next time.